Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of corporate filings so you don't have to. Today we are diving into the KKR Income Opportunities Fund's latest prospectus supplement, and let's just say they are looking to sell some more shares. Alright, so what are we looking at here today? We are dissecting a filing from the KKR Income Opportunities Fund. Ticker symbol KIO. This is essentially a company that manages a portfolio of loans and bonds aiming to provide investors with a steady income stream, and potentially some growth. They are looking to raise up to $75 million by selling more of their common shares. This filing tells us all about that offering and what investors need to know. First off, let S get a feel for the fund itself. As of the 29th of August 2025, it had about 40.8 million shares outstanding. The net asset value per S share, which is basically what the fund S holdings are worth divided by the shares, was $12.82. Now, here is an interesting bit for you. The last reported sale price on the New York Stock Exchange that same day was $12.49. This means the shares were trading at a discount to their actual value, specifically a 2.6% discount. This is pretty common for closed-end funds, and it means you could technically buy in at a lower price than the underlying assets would suggest. The Fund S main goal is to generate high current income, with a secondary goal of capital appreciation. They invest in a mix of loans and fixed income instruments, both in the US and internationally. They have what they call an 80% policy, meaning at least 80% of their assets are in these income, generating investments. They aren't too shy about investing in what is sometimes called high yield or junk bonds, which means riskier debt that offers higher interest payments. Their strategy involves looking for opportunities where they believe their research shows distress or market inefficiencies. Now let's talk about how they are selling these shares. They got a distribution agreement with KKR Capital Markets LLC, which is a part of KKR. This distributor can sell up to $75 million worth of shares. They get a commission of up to 1% of the gross proceeds. Out of that, they pay a placement agent, UBS Securities LLC, up to 0.80% of the sales. This means that for every dollar of shares sold, a good chunk goes to commissions. The advisor, KKR Credit Advisors US LLC, might even chip in to make sure the selling price is in T below the net asset value. This is where it gets really interesting for investors. Let S look at the fees and expenses. You LLC a sales load of 1.00% for shares sold in this offering. Then there are offering expenses borne by the fund itself, which are around 0.06%. On the annual side, we're re-looking at the management fee charged by the advisor. It is 1.10% of the fund, S-managed assets. But when you factor in leverage, which they use through credit facilities and preferred stock, that management fee as a percentage of net assets attributable to common shares actually climbs to 1.51%. This is a big one. The fund uses leverage, borrowing money to invest more. This means they have to pay interest. The filing estimates these interest expenses and payments on borrowing to be 1.30% of net assets. So, when you combine the management fee with interest expenses and other operating costs, the total annual expenses come out to a hefty 3.05% of net assets. Keep in mind, this is on top of any sales load you pay when you buy in. To put that 3.05% into perspective, the filing gives an example. If you invest $1,000 and the fund earns a hypothetical 5% annual return, you pay about $41 in expenses in the first year. Over 10 years, that adds up to $343. This example is based on assumptions, so actual expenses could be higher or lower, but it gives you a clear picture of the cost of doing business with this fund. Let's look at the fund's financial structure. On an as-adjusted basis, reflecting the new share offering, the total capitalization becomes quite large. They have revolving credit facilities and mandatory redeemable preferred shares, totaling quite a bit of debt and preferred equity. The net assets attributable to common shares are shown at $523,813,000 on a historical basis, and after the offering, they reprojected to be $59,801600. This shows a significant increase in the capital base. Now, this is a crucial part for any investor. The filing provides historical price ranges and net asset values. We can see that closed-end funds, like this one, often trade at a discount to their net asset value. Looking at the historical data, for the quarter ended the 31st of July 2025, the price ranged from $11.85 to $12.76, while the NAV ranged from $12.55 to $12.97. This translated to discounts of up to 6.31%. In earlier quarters like October 2023, the discounts were even steeper, reaching over 12%. This discount is important because it means the market S perception of the fund, S value, can be lower than the value of its underlying assets. While the last reported price on the 29th of August 2025 was $12.49, which is a discount to the NAV of $12.82, the historical data shows a pattern of trading below NAV. This section details the at-the-market offering. Essentially, they can sell shares on the NIAS as the market dictates, but not below a certain price, which is the net asset value plus the commission. They and the distributor can decide each day how many shares, if any, will be sold. There is no guarantee they will sell all the shares they are offering. This reiterates the compensation structure for the sales. The distributor gets up to 1% and the sub-placement agent gets up to 0.80%. So that is a collective up to 1.80% commission on shares sold. This part is a bit legalistic. It means they are including information from other documents they've filed with the SEC, like their annual reports and statements of additional information. Essentially, they're saying, go look at these other filings for more details. Specifically, they reincorporating by reference their annual report from October 2024, filed in December of that year. This is where you define the detailed financials for that period. Here, they remind you that this prospectus, along with the accompanying prospectus and incorporated documents, forms part of a registration statement filed with the CC. They also mention that you can get copies of most filings from the CC S. Edgar database. So, what is the story here? KKR Income Opportunities Fund is offering more shares to boost its capital. They attract investors seeking income, but the trade-off is the high fees in the fund. As reliance on leverage, they're historically traded at a discount to their net asset value, which is something potential investors should be very aware of. The 3.05% annual expense ratio is substantial, and that is before sales commissions. While they aim for high income, the costs of managing the fund and the interest on their borrowings are significant. The decision to invest really hinges on whether you believe the income generated will outweigh these considerable costs and the potential for the shares to trade at a persistent discount. Their strategy of investing in lower rated debt means higher potential returns, but also higher risk. The fund's future performance will heavily depend on the advisor's ability to navigate these risks and generate sufficient income to cover these expenses and provide a positive return to shareholders. Alright, that is our breakdown of the KKR Income Opportunities Fund Prospectus Supplement. What is your take on these numbers and what they signal for the fund? Future, let us know in the comments below if you found this breakdown helpful. Give us a like and definitely subscribe for more deep dives into corporate filings. Also, don't forget to join our Discord community, linked in the description for even more insights and discussions. Thanks for watching, and I'll see you next time on Corporate Decoder.